Joy Global, worldwide miner, delivers a killer quarter and raises guidance for 2011 and 2012. Stock up just over 1.5%. Stephanie, is Joy Global a buy? Didn't get a humongous pop on this quarter.
Well, I think that the market kind of pulled back. I think initially it was up about 4% or so. I think what they had to say was really terrific in terms of the revenue growth. They had an asset sale in there as well, so it actually would have been stronger than expected had they not had an asset sale. But the incremental margins, 3.5% higher than expectations, and that's very impressive. And this is in the face of very high raw material costs and uncertainty globally. So I think that it really speaks to the underlying strong demand and their positioning.
So do you want to buy the stock?
Well, we own Caterpillar, and they bought Bucyrus, and Joy Global and Bucyrus are more competitors. So we get the play of Joy Global through Caterpillar. And we've stuck with Caterpillar, even though the stock has declined since they reported earnings, because we see such upside from this transaction. As a matter of fact, Caterpillar raised their guidance, synergy guidance, and cost synergies for Bucyrus when they reported earnings, and I think that there's a lot more that can go.
Any other derivative plays that an investor can get into?
Well, I think the mining sector. I mean,
right.
we bought a little bit of Freeport on the news, and I think also Cummins certainly. I mean, just in general, there's activity in machinery and in industrial activity. So but I think that Caterpillar has come down so much from its high that I think you should be buying that one, especially given the balance sheet and especially given the upside that we see to earnings based on the acquisition.
Now, what about margins? If we do get some kind of quantitative easing round 3, that's going to push up commodity costs, and that could hurt margins going forward. Are you worried about that?
Well, you know what? Caterpillar has always said that $80 to $90 oil is ideal for them. Not 115, not 50. So I kind of keep a close eye on where oil trades. And I think if you stay below 100, we'll be okay. I think once you get beyond that, that's when you have, certainly demand destruction.
Now, this group is also a play on an economic recovery, and I feel like we're getting 50-50 at this point from all the economic data. Yes, factory orders were up. Yes, the Chicago PMI was up. But we've also had a lot of negative Fed data coming out as well. So which way does this play out?
Well, okay, so first you're going to see rates stay low for a very long period of time. That's very favorable in general. Balance sheets will continue to get strong, cash generation as well. I also think that more to the story of, say, a Caterpillar or a Joy Global or a Cummins, it's really the replacement cycle story, where you've had underproduction, inventories are lean, tight. You continue to see tight utilization rates. So just to get back to a normalized demand level, you have to you have to increase your production, which obviously helps sales and that kind of thing. So I like the replacement cycle.
And that's going to happen regardless of what kind of recovery we see.
Exactly. So, certainly you want to be mindful of the macro if it really deteriorates from here. But based on where we are, 1-2% GDP growth is what we're expecting in the second half of the year. These companies can still deliver on the earnings front.
All right. Thanks, Stephanie. I appreciate it. Some industrial, some mining stocks, still a buy here.